Why are UK house prices dropping so fast? It's not just about high interest rates or fewer buyers. It's a full-blown shift in the property market, one that's exposing regional fault lines, financial pressure points, and the limits of policy intervention all at once. Let's start with the obvious. Prices in London and the southeast are falling, and not by accident. These regions, which for
If you enjoyed this breakdown, don't forget to like, subscribe, and drop a comment. Your feedback helps shape what we cover next, and you being here keeps the conversation going. Thanks for watching. See you in the next one.
years led the charge in value growth, are now watching that momentum reverse. Why? Because they're expensive, over-leveraged, and saturated with properties that fewer and fewer people can actually afford. As mortgage rates climb, those stretched monthly payments are starting to break households, and it's forcing some owners to sell. Not because they want to, because they have to. Roughly 800,000 homeowners across the UK are coming to the end of fixed-rate mortgage deals, many of them locked in during record-low interest rate periods. Now, they're facing a reality where repayments have doubled or worse. Some simply can't afford to refinance. That triggers one thing: more properties going on the market. And when too many people try to sell at the same time, prices fall fast. The market isn't just cooling, it's resetting. And it's not happening evenly. While London cools off, the north is heating up. Cities like Manchester, Liverpool, and Newcastle are seeing demand surge. Property values there are climbing, in some cases by double digits. Why? Because they're still relatively affordable. Buyers, especially first-timers and strategic investors, are looking for value. And they're finding it up north, not in London's overpriced zones. That shift in demand is no coincidence. It's being driven by a harsh reality. Affordability matters more now than ever. As wages stagnate and mortgage costs rise, buyers are moving their expectations and their money outside traditional hotspots. It's not just homeowners feeling the squeeze. Landlords are leaving the market in droves. Last year alone, 19% of them sold off their properties. That's nearly 1 in 5. The reasons: rising mortgage rates, tighter regulations, and lower profit margins. The Renters Reform Bill, licensing fees, and tax changes have made being a small landlord riskier and more expensive. Many are choosing to exit rather than try to weather the storm. That creates a double impact. On the rental side, the stock of available homes is shrinking, which pushes rents up, especially in areas already facing shortages. But on the sales side, it's adding more supply. These are new builds. These are properties that were previously locked in the rental market, now being pushed into open sale. More properties on the market, fewer buyers who can afford them. That's a recipe for price drops, especially in already stressed regions. And that's exactly what we're seeing. In the meantime, the government's previous schemes to support buyers like Help to Buy have either ended or backfired. Some buyers who entered the market during peak pricing now find themselves in negative equity. They bought at the top, relying on incentives that no longer exist, and now the value of their property is lower than their mortgage. It's not just frustrating, it's financially devastating. Transaction volumes have dropped by over 60%. That's not a small slowdown. That's a frozen market. Sellers don't want to list because they won't get the price they want. Buyers are hesitating because the costs are too high, the future's too uncertain, and rates haven't stabilized yet. It's a classic standstill where everyone waits for someone else to make the first move. This stagnation is hitting confidence hard. No one wants to be the one who buys just before prices fall further, so people wait. And the longer they wait, the more the pressure builds on sellers who need to offload quickly, whether because of mortgage resets, job relocations, or financial stress. And yet, amid the chaos, opportunities are emerging. Investors, particularly in the buy-to-let space, are shifting their focus. They're targeting the north, where properties are cheaper and yields are higher. While landlords flee the expensive south, a new wave of buyers is moving in where rental demand is still strong and affordability hasn't been crushed. It's a complete inversion of the market dynamics we've seen over the last decade, and it's reshaping who gets to build wealth through property and where. But these shifts are also deepening the generational divide. For younger buyers, especially first-timers, the dream of homeownership is drifting further out of reach in expensive areas. High prices, massive deposits, and unaffordable mortgage rates have pushed many out. Meanwhile, those who already own homes or own multiple are in a better position to snap up deals, remortgage strategically, or hold through the volatility. The wealth gap widens. It's not just economic, it's structural. And it's being reinforced by policy decisions. Landlords are facing more regulation, more tax, and more risk driving many out of the business. But renters aren't winning either. They're paying more for fewer options. And government doesn't seem ready with a real fix. Housing supply isn't increasing fast enough. And intervention efforts either distort the market or arrive too late to matter. Looking ahead, the forecast is mixed. Experts expect only a modest 1% overall price growth in 2025. But longer term, some projections suggest a total increase of 24% over the next 5 years if, and only if, wage growth outpaces inflation and interest rates ease. That means the current turbulence could be the beginning of a longer transformation, not just a temporary dip. But that recovery, if it happens, won't be uniform. London may stay sluggish while cities like Leeds or Sheffield lead the rebound. Regional divergence is becoming a permanent feature of the UK housing market, and that means understanding local dynamics is critical. Whether you're buying to live, to invest, or just trying to remortgage, your success depends on reading the signals. Not headlines, not hype, but hard indicators like transaction volumes, mortgage trends, and policy shifts. That's what separates informed moves from painful mistakes. Because there are opportunities but they're not obvious. You have to dig, research, understand why sellers are motivated, know which regions have upward rental pressure, see where infrastructure is being built, watch what policies are being debated, and, most importantly, don't overpay. Not now. This isn't a time for emotional bidding wars or chasing hot areas that have already peaked. It's a time for cold analysis, conservative budgeting, and patience. The next phase of the UK housing market won't be defined by booms, it'll be defined by who adapts, who buys smart, who exits strategically, and who's paying attention to the right data. This isn't just a correction, it's a reshaping. The government has a part to play, so does the Bank of England. But more than anything, this market will be shaped by those who understand its cycles and learn how to move with them, not against them. So whether you're a buyer, a seller, or an investor, this moment is about clarity, not panic. And not blind optimism either. Thanks for watching. If you learned something today, hit like, share this with someone who needs to hear it, and subscribe for more breakdowns just like this. Drop your thoughts in the comments. Are UK house prices near the bottom, or is there more pain to come? And what region do you think is about to flip from overlooked to red hot? Let's talk. Because beneath the headlines and the market reports, what's really unfolding right now in the UK housing market is a generational reset. We're not just watching a few price charts fluctuate, we're witnessing the slow breakdown of assumptions that held up the market for the past 20 years. For decades, the belief was simple. House prices always go up. The earlier you buy, the better. Hold long enough, and you win. But that equation, it's no longer guaranteed. And it's hitting everyone differently. For homeowners on the edge of their fixed rate term, the anxiety is real. Hundreds of thousands are facing renewal letters from lenders, and the new rates, brutal. Some are going from paying £900 a month to £1,600 overnight. For many, that's simply not sustainable. The only way out is to sell. And once those homes hit the market, especially in already saturated areas like the Southeast, they drive prices down. Fast, not because the homes aren't valuable, but because buyers know they're negotiating with people under pressure. At the same time, buyers are stuck in limbo. They want to act, especially first-time buyers who've been sidelined for years, but they're not willing to gamble. Not in this climate. Mortgage rates are still hovering around levels that feel alien after a decade of ultra-low interest. Even with some discounts and price drops, affordability is stretched to the limit. And let's not forget, transaction volumes are still down by more than 60%. That's not just a cold market. That's paralysis. And what's keeping it there? Uncertainty. Sellers aren't sure if now's the right time to list. Buyers aren't sure if they should wait for rates to fall further. And both sides are staring at the same question: what if I make the wrong call? That kind of indecision isn't just inconvenient, it's corrosive. It erodes confidence. It slows everything. And over time, it creates a market where only the most desperate transactions go through, usually at the worst possible prices for the seller. But here's where things get more complex. While that dynamic plays out in the South, the North tells a different story entirely. In Manchester, Liverpool, and Newcastle, demand is outpacing supply. Prices are rising. Investors are circling. These are not luxury markets or speculative playgrounds. They're value-driven, yield-focused plays. And they're benefiting from two things: affordability and demand from renters who've been priced out elsewhere. That's why some investors are unloading in London and reinvesting in places like Leeds or Sheffield. Not for quick flips but for stable, long-term rental income in cities with strong fundamentals. It's the first time in years that we're seeing a regional power shift on this scale, and it's being reinforced by a growing demographic divide. Younger buyers, often stuck in renting for longer, are now being squeezed by rising rents and shrinking availability. Meanwhile, older generations, many of whom already own their homes outright, are navigating this market with far more flexibility. They're downsizing, transferring equity, or helping their children get on the ladder. The wealth gap is stretching, and housing is no longer just about location, it's about leverage. Who has equity? Who has access to finance? Who can wait? And who can't? Those questions now define outcomes more than postcode ever could. And this shift has implications well beyond the property market. It touches employment mobility, wealth accumulation, family formation, and even mental health. When people can't buy, can't move, or are constantly living under the threat of rising payments, it bleeds into every part of life. Meanwhile, government policy is doing what it usually does: too little, too late. Help to Buy, gone. Renters Reform Bill, still sending shockwaves through the rental market. It's pushed some landlords to quit and left others second-guessing future investments. And the renters they've left behind, paying more than ever, often with fewer protections and less choice. So we end up with a shrinking rental supply, skyrocketing rents, and more people stuck in housing limbo. It's a cycle that feeds itself. High rates push landlords out, gives their properties hit the sales market, gives prices fall in those regions, gives but buyers can't afford new mortgages, gives properties sit unsold or sell low, gives fewer landlords mean higher rents, gives more pressure on tenants. And round it goes. The only group winning in this climate: strategic buyers who know where to look and what to avoid. They're the ones combing listings for signs of stress, multiple reductions, long time on market, vacant possession. They're running numbers on rental yield, not just resale potential. And they're not chasing headlines, they're chasing fundamentals. They know that in cities with growing populations, strong employment bases, and real demand for rentals, today's volatility could be tomorrow's upside. But that upside is still years away. Because even the rosest forecasts are measured, experts expect just 1% growth this year. That's barely movement. And the long-term projection of 24% over 5 years. It's not explosive growth, it's gradual recovery, tied to wage increases, falling interest rates, and expanded housing supply. Which means this isn't a V-shaped rebound. It's a grind. And that grind will test every part of the system, especially those operating on borrowed time or borrowed money. So where does that leave buyers now? In a tricky but not hopeless spot. There are deals out there. Sellers are negotiating. Discounts are real. But the path to long-term stability requires caution. It means avoiding bidding wars, ignoring hype, and refusing to stretch your budget just to get on the ladder. That mentality created too many of the problems we're seeing now. Success in this market won't come from urgency, it'll come from clarity. Look at transaction data. Watch rate announcements. Pay attention to regulation. Know your area. Know your budget. And most of all, don't get emotional. Get informed. Because while the old rules of the housing market are breaking down, new patterns are forming. They're not obvious yet. They're forming in local pockets, in regional data, in policy shifts, and in lender behavior. But those who read them correctly will come out of this cycle ahead, not just financially, but with control over their housing choices. And that's the real goal. Because housing isn't just an investment, it's stability. It's freedom. And for too many people, that's been out of reach for too long. Because even though this market feels chaotic, there's one thing that's becoming crystal clear: it's no longer enough to just own property. The how, where, and why now matter more than ever. Gone are the days where any home in any postcode was a guaranteed win. The UK housing market isn't rising in one straight line anymore. It's splitting, fragmenting. And what we're seeing now is the emergence of a two-tier system where some areas are quietly thriving while others are freezing solid. London is the perfect example. It used to be untouchable, the gold standard, the city that could weather any financial storm. But now, it's slowing, not just in terms of prices, but sentiment. Buyers are walking away. Investors are looking elsewhere. And landlords, especially small, independent ones, are selling up faster than ever. They've done the maths. With higher mortgage rates, stricter regulations, and shrinking margins, many simply can't make it work anymore. Add in the Renters Reform Bill, tax hikes, and licensing requirements, And it's not hard to see why 19% of landlords exited the market last year alone. But here's the twist. Those exits don't automatically make it easier for renters or buyers. They flood the sales market with properties, yes, but most are still unaffordable, or need work, or are in areas where demand is now flatlining. So while the market might technically have more stock, that doesn't mean it's the right kind of stock or that people can afford to take it on. And that's the real issue. Affordability. It's the word that keeps coming up in every analysis, every report, every bear survey, because that's what's driving this entire reset. Not just house prices, but everything around them: mortgage payments, insurance, energy bills, council tax. It's the total cost of homeownership that's forcing people to rethink their next move. And in many cases, it's pushing them away from the places they thought they wanted to live. That's why cities like Manchester, Liverpool, and Leeds are seeing so much attention right now. They're not cheap, exactly, but they're relatively affordable. And that relativity is everything. When a 2-bed in Zone 3 London costs the same as a full terraced house in Sheffield with a decent yield and solid local demand, buyers start shifting their strategies. Especially investors. The smart money is no longer trying to make a quick profit on capital appreciation. It's hunting for yield, stability, rental demand. That's why the North is winning. Because the fundamentals are stronger. And even if prices there aren't skyrocketing, they're stable, and that's what investors want right now. Stability over hype, cash flow over headlines. But here's where things get even more dramatic. While parts of the country are quietly recovering, others are heading into a more painful correction. Not a crash, but a continued, drawn-out adjustment. Areas where prices were inflated by pandemic demand, cheap money, and a false sense of urgency are now seeing reality catch up fast. And buyers, they're watching, they're waiting. They know that rates are still high. They know sellers are nervous. They know the market is slowing. And they're using that knowledge to negotiate hard. That's why we're seeing longer listing times, price reductions, and more subject to sale chains falling through. It's not just sentiment, it's leverage. And it's shifting. Sellers no longer have the upper hand. And until affordability improves or rates come down significantly, this balance is unlikely to change. Which means if you're looking to buy now, you have more control than you think. But only if you're patient. Only if you run the numbers. Only if you don't fall for the emotional traps that defined the last cycle, like rushing into a deal or stretching your budget just to get on the ladder. That kind of thinking doesn't work anymore. Not in this market. The people who will come out ahead in this new phase are the ones who move with purpose, who understand where value really lies, who aren't chasing old market narratives but are watching the new ones unfold in real time. Because yes, the UK housing market is shifting. Yes, it's messy. Yes, it's uncertain. But it's also creating opportunities for those who pay attention. Thanks for sticking with this deep dive. If you're navigating the market right now, buying, selling, renting, or investing, drop your thoughts in the comments. What's happening in your area? Are sellers holding out? Are buyers pulling back? And where do you see the best opportunities in the next 6 to 12 months? Hit like if this helped clarify things, share it with someone who needs a reality check on their house hunt, and subscribe for more brutally honest breakdowns of what's really happening behind the headlines. Because this market, it's only just getting started.